If I was starting a business today, one of the first decisions I'd make would be this: sole trader or company, because the structure you choose shapes how you run your business, how much tax you pay, how you get paid, and what happens if something goes wrong. I'm Stephen Blake, Chartered Tax Advisor and Director of Bristax. Over the years, I've helped many business owners set up the right structure from day one. There's no right answer for everyone, but there is a right answer for you, based on where your business is now and where you want it to go. So today, I'm going to walk you through how sole trader and company structures work. Let's start with the basics. What is the difference between a sole trader and a company structure? A sole trader is the simplest business structure you can have in Australia. It's just you operating under your own name or a registered business name. You'll need an ABN, which you can register for free through a government website. That's it. No complicated paperwork, no company registration. You are essentially your business. From a tax perspective, this means all your business income flows straight through to your personal tax return. If your business makes $80,000 in profit, you're taxed on that $80,000 at your individual marginal tax rate, just like a regular employee. And that's where things get interesting, because depending on how much your business earns, that individual tax rate can climb all the way up to 47%, including Medicare levy, once you're earning over $190,000. Now, the upside is simplicity. One tax return, no separate entity to manage. If you're just starting out and testing an idea, it's the easiest way to get moving without a lot of administrative burden. But here's the catch. As a sole trader, there's no legal separation between you and your business. That means if something goes wrong, if your business racks up debt, or if someone sues you, your personal assets are up for grabs. A company is a completely different structure. It's a separate legal entity. That means the company exists independently from you. It has its own tax file number, its own bank account, and its own legal identity. To set up a company yourself, you'll need to register it with ASIC, the government body which regulates companies. It costs around $800 to do this. If you use an accountant to set up a company, it will cost around $1,500. It's worth noting that there are different ways to set up a company, especially with regard to company shareholding. This is why I wouldn't recommend setting up a company yourself. Not because we as accountants want to charge more fees. We don't. We just charge enough to cover our costs. But because if you don't know what you're doing, it will cost more to fix your mistakes than to do it properly in the first place. I've seen plenty of business structures set up by people, even accountants, who really don't understand the best way to structure a business for a particular situation. From a tax standpoint, companies are taxed at a flat rate of 25% on their profits, as long as they qualify as a small business entity. That's significantly lower than the top marginal rate of 47%, including Medicare levy, for individuals. But here's where it gets a bit more complex. Just because the company is taxed at 25% does not mean you automatically get to keep that money tax-free. If you want to use the company's profits personally, you need to extract the money. And you can do that in a few ways: paying yourself a wage, taking dividends, or even drawing a loan under Division 7A rules. Each of those options has different tax consequences. So if you're thinking a company will automatically save you tax, it's only true if you're leaving profits inside the company to reinvest in the business. If you're taking all the money out to cover your living expenses, you'll end up paying personal tax on it anyway, which can bring you back up to those same high individual marginal tax rates. That said, there are real advantages to having a company structure. The biggest one is limited liability. Because the company is a separate legal entity, if the business gets sued or goes into debt, the creditors can only go after the company's assets, not your personal ones. Having said that though, if you've personally guaranteed a loan, or if you've breached your director duties, for example by trading insolvently, there are situations where you can still be held personally liable. But the company structure does create a layer of protection that a sole trader simply doesn't have. So, when should you consider a company structure? In my experience, there are three key situations where it starts to make sense. First, if your business involves significant risk, maybe you're working with large contracts, dealing with clients who could potentially sue, or operating in an industry where liability is a real concern. In those cases, the asset protection a company offers can be worth the extra cost and complexity. Second, if your business is making over $100,000 in profit and you're able to leave a decent chunk of that profit in the business, that's when the 25% company tax rate starts to work in your favor compared to the higher marginal tax rates you'd pay as a sole trader. And third, if you're planning to grow and potentially bring on shareholders or investors down the track, companies make it much easier to raise capital and bring other people into the business. If none of these three situations apply to you right now, starting as a sole trader is perfectly fine. In fact, it's often the smarter move. You can always transition to a company later when your business grows and your situation changes. Now, before you rush off and set up a company thinking you'll save a fortune in tax, there's one really important rule you need to know about. It's called personal services income, or PSI. If you're providing services mainly through your own personal effort and skill, like a consultant, contractor, freelancer, the ATO has special rules that can strip away the tax benefits of a company structure. Essentially, if you're caught under the PSI rules, ATO treats your company income as if it's your personal income anyway. So you lose the 25% company tax rate and you're back to being taxed at individual rates. There are ways to structure around this, but it can be complex. And you need professional advice if you think PSI rules might apply to you. The key takeaway here is this: don't assume a company structure will automatically save you tax. Depends on your business model, your income level, and how you're operating. So let me give you the framework I use when clients come to me asking which structure they should choose. I ask them three questions. Number one, how much risk does your business carry? If you're a low-risk service provider working from home, sole trader might be fine. If you're dealing with big contracts, liability exposure, or significant debt, a company offers protection. Number two, how much profit is your business making? If your profit is under $100,000 and you're taking most of it as income, sole trader is usually the way to go. If your profit is over $100,000 and you can afford to leave a good chunk of it in the company starts to make sense due to the 25% tax rate. Number three, are you planning to grow? If you want to bring on shareholders, raise capital, or scale quickly, you'll need a company. If you answer those three questions honestly, you'll have a pretty clear picture of which structure is right for you. Look, here's the thing. Most people overthink this decision. They stress about it, getting it perfect from day one. But the reality is, you can start as a sole trader and switch to a company later when it makes sense. Yes, there are costs involved in restructuring, but it's not the end of the world. It's a normal part of business growth. The worst that can happen is that you set up a company too early, spend thousands on setup and compliance, and then realize you didn't need it. Or you assume a company will save you tax when the PSI rules mean it won't. My advice, if you're unsure whether your business will take off, start simple. Go sole trader. Test your idea, make some money. Once you're consistently making over $100,000 and you've got a clear growth plan, then look at moving to a company. On the other hand, if it's clear you will be making reasonable money from the get-go, don't muck around. Just set up a company right from the start. And that's all for now on the differences between a sole trader versus a company. At Bristax, we specialize in structuring and tax advice. If you would like help with your specific situation, contact us via the link in the description below. Thanks for watching. I'll see you in the next one.